The money a business keeps after deducting all costs is known as profit. The main objective of every business, whether it be a little lemonade stand or a publicly traded multinational corporation, is to make money. As a result, a business's success is measured by its profitability in all of its forms. Profitability before taxes and other expenses is more appealing to certain analysts than top-line profitability is to others. Others are only interested in profitability until all costs have been covered. The income statement lists all three of the principal categories of profit: gross profit, operating profit, and net profit. Analysts can learn more about a company's performance by comparing each profit kind to those of its rivals and to previous periods. The first level of profitability is gross profit, which is sales minus the cost of goods sold. Sales are the first line item on the income statement, and cost of goods sold, COGS, is generally listed just below it. Gross profit is revenues minus costs of goods sold. Operating profit removes operating expenses like overhead and other indirect costs, as well as accounting costs like depreciation and amortization. It is sometimes referred to as earnings before interest and taxes, or EBITDA, which I will explain in a bit. Operating profit is revenues minus cost of goods sold minus operating expenses minus depreciation and amortization. Net profit, furthermore, removes the cost of interest and taxes paid by the business. Because it falls at the bottom of the income statement, it is sometimes referred to as the firm's bottom line. Net profit is EBITDA minus interest expenses minus taxes. A company's bottom line shows how lucrative it was over a specific time frame and how much is left over for dividends and retained earnings. What's left over can be put to use for initiatives, debt repayment, or reinvest back into the business. Number 2. EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and is a metric used to evaluate a company's operating performance. The EBITDA metric is commonly used as a loose proxy for cash flow. It can give an analyst a quick estimate of the value of the company as well as the valuation range by multiplying it by a valuation multiple obtained from equity research reports, publicly traded peers, and industry transactions. Investors can also use EBITDA to evaluate a firm when it is not turning a net profit. This statistics is widely used by private equity firms since it is excellent for comparing similar businesses in the same sector. Business owners use it to assess how well they are performing in comparison to their rivals. Number 3. Equity. Equity is the sum of money that a business founder has invested in or owns. A company's equity is represented on its balance sheet by the difference between its liabilities and assets. The equity value is calculated using the share price or the value decided upon by investors or valuation specialists. The amount of money delivered to a company's shareholders if all of its assets were sold and all of its debts were paid is known as equity, sometimes known as shareholders' equity or owner's equity for privately held firms. It is the worth of the company's income less any debts that are not a part of the acquisition in this situation. Number 4. ROI. ROI is calculating the monetary value of an investment compared to its costs. The mathematical formula is profit minus cost divided by cost. If you make $10,000 in revenue on a $1,000 investment, your return on investment, ROI, would be 0.9 or 90%. The calculation can usually also be done using an investment calculator. ROI can be useful in evaluating the potential return on a particular investment or your marketing campaigns, accountability in the marketing metrics, as well as in developing business plans to start your business. A similar metric is return on ad spend, ROAS. However, this focuses more on specific strategies, such as a single ad campaign to grow your business. Next point, gross margin. Gross margin is net sales less the cost of goods sold. In other words, it's the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. The higher the gross margin, the more capital a company retains, which it can then use to pay other costs or satisfy debt obligations. The net sales figure is gross revenue less the returns, allowances and discounts. Next one, PPC. PPC or pay-per-click is a type of internet marketing which involves advertisers paying a fee each time one of their ads is clicked. To put it simply, you only pay for advertising when a user clicks on your ad. In essence, it's a way to purchase website visitors in addition to generating them naturally. One of the most common forms of PPC is search engine advertising, which allows advertisers to pay for ad placement in a search engine sponsored links. This works when a customer types in a keyword associated with their product or service. For instance, our ad can appear at the top of the Google's result page if we bid on the keyword Best Finance YouTube channel. Now you may ask, who should use that? PPC advertising is ideal for small businesses as you get to decide how much you are willing to spend on each keyword, so you can manage how much you will be spending when your ads are displayed. In essence, this ensures that the money you spend on ads isn't wasted, as you are more likely to attract more people who are interested in your product. And the last one for today, Customer Acquisition Cost, or CAC, measures how much an organization spends to get a new customer. The overall cost of sales and marketing efforts, as well as any property or equipment required to persuade a consumer to purchase a good or service, is known as the CAC and is a crucial business metric. To determine whether a business is running efficiently, it is common to analyze CAC along with lifetime value of a customer, which is an estimation of how much revenue an account will bring in over the course of its lifetime by continuing to buy from or subscribe to for a longer period of time, or monthly recurring revenue, the measurement of revenue generating by month. How to calculate CAC? The first step in calculating your customer acquisition cost is to determine the year period that you're evaluating for, month, quarter or year. You can focus your data's range by doing this. Then, add together your overall marketing and sales expenses and divide that total by the number of new clients acquired throughout the period. The projected cost of bringing on a new customer for your business should equal the result value. For example, let's say your company spends 500k on sales and 300k on marketing. Additionally, your company generated 800 new customers during the last fiscal quarter. Therefore, if you were to calculate the CAC for your business, the cost to acquire a customer for that quarter would be $1,000. Why? Because 500k plus 300k divided by 800 is 1k. Once you have determined the CAC for your organization, you may contrast this figure with other important financial indicators. You will get important information about your marketing, sales and customer serving campaigns by doing this. Danke fürs Zuschauen, Bres. Thanks for watching. And check these videos here out. And yeah, thank you. Bye bye.